Thank you for that. Thank you for that kind introduction. And for all of you that have worked with Fireside and with Kanwal, you know it is very hard to say no to him. So if you're wondering what the trick was to get me here, that was the trick to get me here. I tried in my own subtle ways, and it didn't work. So here I am. But let me just start by congratulating you on a phenomenal AGM, because I have attended a fair few, and it is very rare that at the end of your session, you've got a full room. So the passion of your team, as well as the founders, has clearly come through in terms of the exciting businesses that you are building. And so truly, congratulations and well done on a fantastic day. So, you know, when Kanwal said, come and talk to us about what's going on globally and India's place, every time I sat to think about what am I going to talk about, the macro world changed on me, right? I started 2026 thinking, yeah, well, you know, we'll get back to business as usual. Didn't last. And so what I thought I'd do is I'd share a little bit of the questions that investors are asking globally, and a little bit of what our IC is discussing, what are some of the questions that were coming through. We certainly won't get through all of them. It will require an entire day for the debate and the discussion that we need to have, but I'll just touch on some of the themes. And these are the big questions that is being talked about in ICs with CIOs, and as people start thinking about allocations and what they want to be doing with their programs. So let's start with themes and trends. You know, as I said, 2025 was a year of uncertainty, right? Macro took over everything. It seems so long ago that we were worried about only tariffs in terms of what we had to deal with. There were supply chain disruptions, rapid evolution of AI. Volatility peaked, but then it felt like in the second half, people got back to business as usual. As 2026 started, as I said, I thought we would get back to business models, revenue projections, margins, what are we going to do? That moment did not last very long. Attention turned to private credit, and you were seeing some of the disruptions come through over there where some were talking about, is this the boy who cried wolf, or is there really a problem in there? And I'm sure all of you remember where you were on the weekend when we started seeing the beginning of another war on the doorstep over here in West Asia. So, you know, it does feel like where macro had been an issue was going to go away. It's come back, and this conflict clearly has brought energy back in a big way in terms of discussions and what we're going to be focused on. But one of the things that I'm very grateful for in terms of being in the private equity industry is that these dynamics that you've got only come through in the second order. And what do I mean by that? There is a lag in valuation changes in terms of the sharp changes that you see in public markets. It allows us to adjust business models. It allows us to think through things as opposed to having to react so immediately in what we do. And I, for one, am very grateful for being in an industry that allows you 10-year lockup capital. I wanted to share a little bit of some of the existing and emerging ideas in our portfolios. And the big one in our organization that everyone talks about, whether it is to use individually, to use at an organization level, or what's happening in the world, is AI. It is everywhere and has various implications in the world. It's not just an industry or sector anymore. It's almost becoming an asset class, and it's having an impact both on public markets as well as private markets. The most valuable public companies have AI embedded in their business in their business models. And what's kind of interesting is that, you know, companies like OpenAI and Anthropic barely existed 10 years ago. And you just look at the pricing that it commands and the change that it is going through. But really what is interesting for me is not only is it AI in itself, it is driving record investments in credit, in infrastructure, especially data centers, and power capacity. So we're seeing an intersection of venture capital, strategics coming in, private credit, all of these converging to build the infrastructure of tomorrow. And I think everywhere you heard Nandan talk about this, everyone wants that own sovereign access to all of these things that's going to drive returns. Now, when internally at Harbourvest, we're just having discussions on the state of global private markets, there are 4 indicators on the health of private markets that we look at. So we look at year-end data in terms of exits, investment activity, fundraising, and dry powder. Private markets clearly globally bottomed in 2024, and we started seeing indications that things were beginning to come back in early 2025 till Liberation Day came when everything paused. But in the second half of 2025, it felt like we were beginning to see a rebound for the rest of the year. What led in terms of this change is investment activity. And that was followed by accelerating exit activity. I know we all talk about DPI, there isn't enough of it. We'll come to that in a moment. But I will say that we did see accelerated investment activity as well as exit activity. And what was interesting is that in 2024, for the first time in a decade, we saw a decline in dry powder that existed in the market. And so there was something healthy happening to some extent in terms of that dry powder getting used, some exits coming back, and we think some of that will continue. But if I had to use one word to describe what 2025 meant for us in terms of private markets, it really is scale. And why do I say that? The largest ever buyout took place, $55 billion, Electronic Arts. You saw the largest venture financing take place. This is $40 billion in Anthropic at a valuation of $850 billion. 2 of the largest IPOs ever in the US and Europe took place, and the largest private credit debt package was also announced in 2025. It just gives you a sense of the scale of what private markets have grown to on a global basis. Now, the most important question, performance. It's the only reason we're all here, because we believe in the asset class and we believe that those returns can be generated. Over the long term, as you can see, private markets have delivered consistent double-digit returns. Near term, they've lagged public markets, mainly driven by large cap tech. So in short, this can happen, but I think all of us sitting over here are big believers in this in terms of the returns that can be generated. And our investment success, frankly speaking, why we invest in groups like Fireside is because we know success relies on innovation, on entrepreneurship, professionalization, transformation, and value-added capital to drive efficiencies to the business. And that's what we are expecting. One-year performance has definitely improved across regions. And for someone who has built her career on private markets, I am truly hoping 2026 is where the privates are going to outperform the publics again. Now, on the investment side, there are 3 themes that I just wanted to highlight in terms of what we're seeing come through. One is global infrastructure. We just talked about that briefly. It has been the best performing asset class over the last 3 years. Longer term, it has delivered equity-like returns with the lowest volatility, demonstrating the targeted benefits of infrastructure, providing resilient and less cyclical performance and inflation protection. And we're big believers that some of the structural changes that you are seeing is going to continue to drive investment here. Aging grids, electrification, decarbonization, AI-driven computing power, supply chain resilience, all of this is going to continue to benefit investments in infrastructure. The second growth area that we have seen has been private credit. And this is expected to grow to about $2 trillion in the coming years. Just across global direct lending, there was about $250 billion of volume that was executed in 2025. Now, you are seeing a lot of headlines in terms of companies where the credit writing may have been poor. I think one of the things we will all agree on, this is a space that needs watching, particularly in terms of the due diligence and making sure that you have proper due diligence, you have good controls, and good underwriting that is taking place. And the third trend is the secondary market. Now, the lack of conventional exits has caused a big buildup in net asset value, and LPs are constantly looking for liquidity, a lot of times to make new commitments in the asset class. And this has led to the phenomena of putting out private equity portfolios for sale, and there has been a lot of interest in buying some of these assets. Whether you read Evercore's report, UBS's report, or any of the reports, they will tell you that global secondaries surged over 40% from last year. So in 2025, they say about 200 billion of secondaries got done, which is a significant jump up compared to what you've had in the past. And secondaries will continue to benefit from the structural tailwinds, including the scale and the expansion of what we've seen in private markets, and GPs and LPs' growing reliance on secondaries as an active portfolio management tool. Now let's just move for a moment to investment activity, right? Investment activity emerged as the leading indicator as markets recovered. This year globally wrapped at $1.5 trillion in total volume, which is a 32% increase from 2024. That is quite a significant increase. Now the deal volume increased, deal count decreased, because a lot of this was driven by bigger deals. And particularly in the US, what you started seeing is deals that were $1 billion and larger in size increased quite significantly. Again, when you look at sort of what's driving some of this, there are three big themes. One is publics to privates. We talked about electronic arts being the biggest one that did take place. And many of the companies don't want to be on listed markets and are willing to step off in terms of private markets. So P2P, the electronic arts is one that I talked about. And the other one that was interesting is Dayforce, which was taken private by Thoma Bravo. This is a SaaS company. And while sitting in public markets, they would not have been able to do all the transformation that was needed in terms of embedding AI into their business. And so Thoma Bravo saw the opportunity to take them private and start building for a new age company. So this has driven a lot of deals across US, Europe, as well as Asia. Now, the mega venture is the discussion that we have a lot at our investment committee. Part of this is, where should you be investing? Is it in the smaller funds? Is it in the larger funds? Do you only want the companies that matter, like an Anthropic and AI? Or do you want to build a portfolio that has opportunities to put new businesses in business? Now, the answer at Harbourvest always is diversify, just so you know. That is the answer to everything that we do, which is diversify. But it is interesting that you have seen venture funds raise $10 billion. And they are participating in terms of an open AI where $40 billion was raised, Anthropic raised $30 billion, and XAI raised about $20 billion. These are the largest ever financings that have taken place in venture capital and have driven a lot of the numbers. And then lastly, you're going to get tired of me hearing me talk about AI, but this is a big theme that is taking place where we are seeing M&A, because people want access to AI, and you are seeing a lot of P2P also take place in terms of access to the technology that is going to drive the companies of tomorrow. There is just absolutely no getting away from it. I will tell you, at Harbourvest, they try and train me in terms of using it. They have failed. I have to go and find someone who is going to make a better student of me in terms of doing that. Global private equity exits, something that we all wait for. Exits ended the year in 2025 at about 1.1 trillion. This is up almost 50% from 2024. So despite the headlines that you see, there is exit activity taking place. It is just not at the scale and the volume that we need given the inventory that has built up over the years. There is a growing hold period in terms of what we're seeing. Now, what has gotten good is that the traditional paths where we had just M&A and IPOs has broadened. You will have seen for SpaceX, maybe many of you have even got the opportunity to invest in SpaceX and secondary sales that have taken place. Stripe is another one that has taken place, and secondaries are all beginning to broaden the paths in terms of how to deliver secondaries, and that's something that we continue to be participants in and also very excited about. If I just move on to the next slide where, liquidity matters to all of us. Again, as I said, you are seeing liquidity, but I think the fact of the matter is it certainly is not at the scale and the size that we need. One of my colleagues told me that the inventory of PE companies has steadily increased to more than 13,000 companies that need exit. And about a third of these are about 7 years old. So you can see why there is that urgency where people may not want to go IPO in terms of what they want to do, but there is a desire to want to get exits back because that model of velocity is what is needed to keep this industry going. The winning assets are securing exits more quickly in an improved market, driving exit recovery, while those that are slower or have not put in the AI models or new ways of doing business are lagging in terms of building. Equity markets have seen IPOs, as I said, Figma, Circle, Klarna, Medline, all of these. And India, frankly speaking, has been a great beneficiary of what public markets have done for so many of these companies. What's also nice is that you are seeing across the world more companies announcing that they want to go IPO. And I think that tends to build momentum, that tends to build confidence, that tends to build a lot of excitement in terms of what we're going to see. And we remain positive that, in the second half of this year, that we will see more to come. But in the meantime, while we're waiting, larger secondary deals that have gotten done. A decade ago, 50 billion was considered a good year for secondary transactions. Today, we're at 200 billion. It's probably the only financial market that I know where everywhere else, the secondary market is much larger than the primary market. In this case, the secondary market represents somewhere between 5 to 7% of the primary market. So you can see how much, in terms of structural tailwinds, the opportunity to grow is quite significant. Deals are split between GP-leds and LP-leds. The New York City, who is a large investor in the US, put out an LP portfolio, about $5 billion that got transacted. That's one of the largest ones that we've seen, but we are expecting that these will continue to grow, possibly up to 10 billion in terms of what's coming out to market for liquidity that we want. Finally, maybe just moving to fundraising. Fundraising, as I noted earlier, has lagged. People have been reluctant to come out. People recognize the challenges. LPs have very large portfolios. Velocity has not worked for them. But given you have seen increased activity in terms of fundraising, in terms of investment activity, I suspect that managers will be coming back to markets on a global basis. It is going to start being a busy year in terms of 2026. We have seen a bifurcation in GPs in terms of those who can raise and those who cannot. Anyone that's had a great track record and access to the best companies continues to raise in no time at all, whereas those that have some blemishes on the track record continue to struggle. The other trend that we're seeing in terms of fundraising is there are two types in terms of a winning formula. You have someone who's a platform and wants to build across to provide access from an early stage all the way to the late stage, or doing large buyouts and small buyouts, or then you have someone who is a specialist. And that specialist is able to deliver value in a way that can help companies scale and grow faster. And so even in a fundraising market, which is down about 20% relative to 2024, there are managers who are getting one and done closes in terms of fundraising, because there is a lot of interest in continuing to build programs for private equity. And then one of the things that I'm going to end on is 2026 predictions. These are not my predictions, by the way. They're Harbourvest predictions. What we do is we invite many of our investment chairs. We have 5 different strategy chairs. They come together and they help make predictions in terms of what we're going to see in 2026. And during the course of the year, what we do is we'll put out insight papers on whether those predictions came true or didn't come true in terms of where they stand. So I'm not going to go through the predictions, but you can see that there is Some things that seem obvious, whether it's renewables or private markets architecture, will be refined. Some of the others will just have to wait and see. But that was really what I wanted to end. I did not want to talk about India and India's place because I think the team today has done such a phenomenal job in terms of talking about what's possible in India, the kind of companies that we've grown, and Nandan during his remark was a visionary in terms of what else we can do. But I thought I'd just share with you a little bit of global insights into what is going on in the private equity markets, and at least how we sit to think about allocations, about timing, not that you can time markets, but timing in terms of when venture is going to come back, what's going to happen on buyouts. Now, I know I've got some of my colleagues sitting in the room, and I know I have global peers over here. So they will all keep me honest in case I have said something or that they have different views on that. So I would invite anybody that would like to share either insights or happy to take questions if anyone's got them.
Hi, I'm Dipanjan here at Fireside. Thank you again for your time here. Very, very good insights. I think you briefly touched upon the point on a specialist versus a platform view. Now, even we are a specialist such as early stage venture, but within that, we are a even more specialist of being consumer. And when we sometimes talk to global LPs, we find ourselves the question that, hey, are you very niche? Is it very specific? Is there enough TAM? But all the trends which you talked about also leads to the fact that in future, whether it is AI, whether it is India, it is becoming more and more nuanced. It is becoming more and more deeper in understanding, deep tech or space tech or consumer. So do you see venture firms coming, the next generation of venture firms in the next 5-10 years will be more specialists, even within stages like within venture, you see more consumer funds, deep tech funds. Is it very unique to India, or are you seeing this globally play out as well?
Oh, it's a great question. It's an evolution that we have seen in many markets, right? That everyone starts with a little bit of a generalist approach because you want to have broad market coverage and you want to be able to see what's interesting. And over time, as markets mature, markets deepen, or subsector becomes available, you need specialist knowledge in order to do that. I'll share a little bit of maybe my, at least, personal experience in China. We started with complete specialist funds on the venture side, right? And a lot of it came with global groups that had sent someone over to just set up the office and get going. And it was a great model at the beginning when venture was just getting started in China. Then you started seeing that all of a sudden there was not just consumer tech, but there was biotech that was coming. And there was no way that a generalist was going to be able to do biotech. And so you had two models, right? Either someone went and hired someone within the team, but even if they hired someone within the team, what happened is that the others didn't understand the deals. So it became, can you have an investment committee that understands what each other's doing or not? And so people would break off to set up on their own. Then you have, whether it's deep tech, robotics, and the like, you need engineering knowledge, you need to have the manufacturing knowledge. And so I think what happens is as ecosystems develop and maturity comes in, that ability to have the specialists who can go deep into the companies and do what you all do with your entrepreneurs in terms of taking the insights, in sharing the experiences that others have had, becomes a very important part of the portfolio that we're looking to build. So I'll just say, don't go generalist, because then you've got to scale, and with scale, you don't always get the returns, but if you can stay specialist in terms of growing with what you can develop, I think there is a lot to be said for then other things that you can be doing within the platform that you build. Please. I think there's a question.
Hi, thank you for a fantastic overview of the private market. I'm Nishant Singh. I'm also an LP in the fund, and I'm a lawyer by profession. Just wanted to get a little more insight into the private credit market. You briefly alluded to it, and obviously they've been making a lot of headline, and all of a sudden we see a lot of rush in the global market where LPs are actually going and liquidating those positions and asking for funds back. and the funds are putting the gating. And particularly in India right now, obviously private credit is on a spree. We see a lot of global funds coming in. We see a lot of domestic GPs also attracting a lot of global capital. And in an economy like us, obviously we need far more credit growth for equity growth also to happen. Do you see any cascading impact of that in the Indian market? Or you also alluded to the due diligence. So as a fund of funds now, do you see any difference? I'm assuming so, but what that is exactly?
Yeah, no, it's a great question and it's a great observation, right? And I think what I'll do in terms of the answer is let's separate the credit opportunity with what's happening in the gating in the evergreen funds today, right? I think, the democratization of alternatives, I think, is a fantastic change that we're seeing in terms of giving access to this asset class to those that want it. What is really important in terms of anyone investing in evergreens is always remind yourself that even though there is liquidity, it is an illiquid asset class, right? And the whole idea of creating the gating and creating the structures that were created in some ways is to save you from yourself. Don't panic in terms of going out at the earliest moment in terms of trying to pull things out. So there is a structural thing that you need to think about there, whether it is education, whether it is why am I going into the asset class? Do I recognize that it is an illiquid asset class? And frankly speaking, I need to think about this. There's a reason that all of the institutional investors have 10-year lockup capital, whether it is in private equity or in private credit in terms of doing that, right? And then let's talk about private credit as an asset class that you want to get into. I think there is an incredible amount of growth. There is an absolute incredible amount of need. And you look at a country like India, right, to a great extent, where there is growth opportunities. Not all of it is going to get equity financed in what you do. The support on the credit side is needed to continue growing what we do. So I continue to think that there is a lot of opportunity. I think what the reactions, whether it is of locked up capital or evergreen capital, right, in terms of how they behave in these times of panic, will differentiate between those that can deliver the returns and can deliver what they set out to do versus those where there are more poorer controls, less governance over there, and the underwriting has not been that clear. I think it's like all these things, right? When they proliferate till all of this is tested, it's harder to see through that. But I think credit by itself plays an important role, and especially globally, banks stepped away from it, and these funds played a critical role in terms of enabling transactions, in terms of enabling growth. And it's kind of interesting to me, at least in the US, to see that all the commercial banks want to buy the paper, right, in terms of what you're seeing. So that tells you that there is a moment of panic, but there continues to be great opportunity in terms of what you can invest in. Please.
Thanks, Hemal, for your insights. How bullish are you on...
No tough questions, okay? Go on.
How bullish are you on Indian venture capital, other than Fireside, of course, and how do you and how do you compare that to in Indian venture ecosystem compared to global venture?
So for those of you that know me, you know that for the longest time ever, I was not very bullish on India. And part of that was this realization and this learning, right, that came where it is not that people aren't smart, that they don't know what they're doing. It requires an ecosystem to continue growing for you to be able to do what you want. So one was ecosystem. The other piece around a lot of this was, today when I look at the things that have been done well, right, whether it's physical infrastructure, digital infrastructure, you've also seen the ambition of entrepreneurs grow, whether they have seen in other markets what could be created, or they have seen an opportunity because of a problem where they are going to go solve a problem. So I think there are a lot of ingredients that are coming and have come together very well for the Indian market to be able to do what we want. Now, one thing I have learned is exuberance does not do me good in terms of portfolio construction, right? So when I said diversification is generally the view at Harbourvest, it is sitting to think about, as this ecosystem grows, how much exposure do I want? In what shape or format do I want it so that if a downturn comes, which it does, right? Everywhere it comes, it is something that I am comfortable with, I am not losing sleep over in terms of doing that. I think today, companies that have gone public, right, for all of you that also invest in public markets, especially the new age companies that have gone public, you know, the question is, will they deliver to the expectations? If they're able to deliver on all of that, I think this is going to be fantastic because there will be the next set of companies that either want to IPO, M&A, whatever it might be, right? But it is that step-by-step building that has to take place in terms of continuing to build the confidence in terms of what you do. So yes, compared to before, I am very, very excited about it, but in the recognition that if you are building a global portfolio or an Asia portfolio, how do you think about what are the signs you're looking for that the maturity is beginning to come and you're ready for the next phase in terms of adding more to the portfolio? With that, I think I am going to say thank you very much for your questions, thank you for your attention, and thank you for the kind invitation.